According to supply managers in the 9 Mid-America states, how is the economy performing?
The overall survey number for the month of October was 51.1, and that's up from 48.1 last month. And that's what we've been seeing is the overall reading, and that's true for the national number, that's true for the region, our regional number, vacillating up and down, below and above growth neutral. In fact, that's the fifth time this year, and of course that's 10 months. Fifth time this year the index has been above growth neutral. Of course, that means 5 times below growth neutral as well. We ask about the greatest economic challenges faced by the firms, their firm, the manufacturing firms, of course. And supply chain disruptions by far was the greatest threat as they saw it. Now that's at 39.9% of the surveyed participants. Now a lot of that perhaps hinges around what's going on in the Middle East and what any supply chain disruptions that could come out of that, but also other supply chain disruptions. For example, longshoremen strike, those other issues faced by supply managers. The second biggest threat, as they saw it, was inflation, which was 27.8%. Next was labor shortages, and that's surprising. It was only at 11.1%. Cyber threats, 5.6%. Of course, that leaves 15.6% of other identified threats faced by the firms that these supply managers are reporting for. Now here I'll bring up the chart, and there you see the index there in Creighton blue, and that's 51.1, and then red you'll see the U.S. number, the national number, which will come out later on this morning, and I expect it to be up as well, not up significantly. Now again, these indices range between 50 and 100, with 50 being growth neutral, so our index is only slightly above growth neutral. And if you look back over the last 18 months, you'll see that it's been up and down around 50 point, around growth neutral. So not surprising. We'll see the national number again come out this morning. I expect it to be not above growth neutral, but up for the month.
What were the hiring trends?
Hiring was not good, like it has not been good for many months now. The October number was 44.2, well below growth neutral from September's 44.3. Now manufacturing growth across the nation, for example, the U.S. manufacturing sector has lost 43,000 jobs this year alone. That's since the beginning of the year. That's 0.3%. 5 out of the last 9 months we've lost jobs. The U.S. has lost jobs. The region is down 3,700 jobs, which is also identically 0.3%. Lost jobs for 4 of the last 5 months, so not good in the jobs front. We're losing manufacturing jobs, but not a very fast pace, so it's nothing to get concerned about. We had the underperformers, that would be Iowa, Minnesota, Oklahoma, and South Dakota. They lost manufacturing jobs, but on the positive side, we had Arkansas, Kansas, Missouri, Nebraska, and North Dakota all gaining jobs, but even there the gains were only slight for the year. Labor shortages, even though the not a big threat as identified by the supply managers, remains an issue, and it continues to restrain any growth in certain sectors where labor remains in short supply.
What inflation trends are you noticing?
Inflation is good, meaning well constrained. Price gauge slipped to 56.5, again, only indicating elevated inflationary pressures, but not significant. And that's down from 56.6 in September. So that's pretty good news. I think the national number that'll come out later on this morning will show the same thing, that inflationary pressures at the wholesale level remain tame, but I'd be concerned about that looking forward to next year. That inflation has not been conquered just yet. All items CPI, that's the Consumer Price Index, annualized over the last 3 months, up 2.4%, and the core, which excludes energy and food, was up 3.2% annualized. Both those numbers are annualized. Inflation remains still above the Fed's target of 2%, no matter what gauge you use. Inflation is above the Fed's target. And I expect even with that, we'll continue to see Fed rate cuts. We'll see a rate cut on November the 7th, the next meeting. the Fed's getting these should not be cutting rates like this, but they have to protect the federal government, running these huge deficits and huge debt, and making sure they don't increase interest rates to the point where the federal government can't afford their debt. Supply managers, again, average price of inputs about 6.2% is expected over the next 12 months, and that's a bit rich there, a bit too high.
What is the economic outlook?
I expect, as I said, a rate cut on the February, when the Fed next meets on November the 6th and 7th, 25 basis points. They got way ahead of themselves last time with a 50 basis point cut. That's a half percentage point. That was too much. They're now going to reduce rates, but again, what's driving this is not they've conquered inflation. One of the issues is the federal government is running deficits and debt where the interest expense for the federal government is now bigger than what we have in terms of the military budget. So we're spending our grandkids, our great-grandkids, we're spending their living going forward. Keep an eye on Federal Reserve's balance sheet, though. That'll tell you a lot about what's happening in terms of the federal government or the Federal Reserve. And just go to Google and type in Federal Reserve balance sheet, and you'll see that number. They were bringing down that balance sheet. Now, what the heck does that mean? That means they're allowing the debt to roll off their balance sheet. That means they're allowing, they were holding these federal debt and mortgage-backed securities. They're allowing them to mature. Now, what the heck will that have an impact on? It will allow and push interest rates higher on the long end. And we have seen that over the last several months. Long-term interest rates are rising, even though the Federal Reserve is cutting rates. They're cutting short-term rates. At the same time, long-term rates are going up. I expect those long-term rates to continue to move higher, and we're going to see mortgage rates approach 7%. And of course, that's going to put a little dent in the housing, and we'll see that housing sales, home sales. Keep an eye on the bond market. That's where the real action is. The 10-year Treasury, as I said, is now rising. It's up to 4.3%, and that's up from 3.7% before the Fed began cutting rates. Again, they're cutting rates on the short end. On the long end, we investors are pushing rates higher. And again, the reason those rates are going up is because inflationary pressures out further in the year, that would be in 2025, are going to be rising, and that's going to put upward pressure on interest rates as well, and on the long end. But on the short end, you'll see lower and lower rates on the short end. Keep an eye on the national ISM readings and our readings as well. That's the Institute for Supply Management. That's the PMI's Purchasing Management Index. That's the index identified in our opening there. Those numbers are looking better, but even with that, you're still seeing an economy that's moving sideways. And that's, of course, not good. We'd like to see more growth. Unfortunately, a lot's going to depend on what happens in the elections on November the 5th. We have two candidates, both of whom are putting out some economic programs that don't make sense. From an economist standpoint, we don't have a good choice there. Both candidates are really, I would say they call it word salad. I'd say it's word salad on both sides there. And also watch the price of a barrel of oil. That has been coming down, moving down. And that's a good signal, but why is it moving down? Well, it's moving down because of excess supplies out there right now, and also demand is slack. We're seeing slacking demand out there, whether it's Germany, whether it's Europe, whether it's China, whether it's Japan, the U.S. These economies are not moving up in a brisk pace. As a result, demand for oil is moderating and coming down. And watch the price of gold. Gold has been moving up, and I expect it to continue to move up. Now, we may see some sideways movements in the next few months, but nonetheless, gold remains a good investment. We've got central banks across the globe buying gold, and pushing up that price. It's at record levels. Never seen gold this high priced. And we're seeing it also because of BRICS. That's the BRICS nation. They met in Kazan, Russia, and the BRICS nations, that's Brazil, Russia, India, China, and South Africa. what they're doing is buying gold. They intend ultimately, now it's going to take some time, I expect to see them launch a digital currency backed by gold. So they're buying a lot of gold. Now what the digital currency they're launching, the intent is to undermine the US dollar as a reserve currency. Now what does that mean for Americans? It means you're going to see higher interest rates. Higher interest rates are baked in right now, and unless something happens dramatically, and we will have to see some dramatic action from both the Congress and the new U.S. president, whoever that is, you've got to see some action on government spending, else you will continue to see higher inflation and higher interest rates in 2025, probably in the second half of 2025. So that's our survey, and that's the outlook. Not so good for the U.S. economy, the regional economy, but it could be worse. Until we meet again next time, the first business day of December, may your economic cup runneth over. This is Ernie Goss with Creighton University, and see you next month.